In this episode, we're going to cover the charitable tax planning concept of a qualified charitable distribution, or a QCD. A QCD is a distribution that is made from a traditional IRA, an individual retirement account, which passes directly to a charitable organization instead of to the retiree. And the donor receives an immediate tax benefit because the distribution is not included as gross income. The distribution also counts toward meeting the individual's required minimum distribution, or RMD. Let's quickly cover the basics of an IRA. Traditional IRAs are funded with pre-tax dollars, which qualify for deductions against taxable income in the year that the contribution is made. So you receive income in a taxable year, and instead of depositing that money into your checking or your savings account, you instead deposit it into an IRA, and you do not have to pay any income tax on that money in the year that you made the contribution. So what goes into the IRA is pre-tax money. And when you take that money out of the account as a distribution, you will pay income tax on each distribution. With a QCD, you essentially assign some or all of your IRA distribution to a charity rather than receiving it outright. So you avoid paying income tax on that amount. Now, this is an excellent result because it circumvents the analysis that we addressed in a previous episode surrounding itemized deductions versus the standard deduction. In that episode, we explored how the tax benefit of charitable contributions can be hugely impacted by whether the donor takes the standard deduction or itemizes their deductions. So just as a quick reminder, if you make a charitable contribution in a taxable year in which you take the standard deduction, which you should do if the standard deduction exceeds your combined itemized deductions, you will not, broadly speaking, receive any tax benefit of your charitable contribution. So what's great about a QCD is that the contribution is not included in your taxable income, and therefore an itemized deduction is not necessary. This is very important because you do not have to itemize the contribution to receive an immediate tax benefit. You receive the tax benefit from your contribution whether or not your itemized deductions exceed the standard deduction. So in that way, it functions like an above-the-line deduction. Let's hit quickly on the requirements and limitations. So first, you must be age 70 and a half or older to take advantage of the QCD tax benefit. The benefit is capped at $100,000 per person. So for married couples, you can double that. Each spouse is entitled to a $100,000 distribution, totaling $200,000 for the married couple. And generally, the same rules apply for simple and SEP IRAs, but the distribution will not qualify if an employer made a contribution to the account in the same tax year that your QCD is made. Now, one of the most important requirements is that the distribution must be made directly from the account trustee to the charity. The donor cannot receive the payment and then write a check to the charity. The direct transfer is very important. The amount gifted through a QCD is not included in gross income. So it could potentially reduce your effective tax rate, meaning if you're not receiving the income, if it's not counted toward your income, you fall under the progressive tax rate based upon your income aside from the distribution. So this benefit is lost if you receive the distribution and then write a check to the charity. It's as if you receive that income, you have to report the income and then write a check, and then you're stuck back in the land of itemizing deduction. So as a side note, this is actually how a lot of people function when they don't utilize this tool for charitable giving. they're not thinking about it. So they may take their RMD and then their charitable contributions are just made in cash or by writing a check or whatever means they normally use, but they're not thinking about using their IRA as a tool for making that distribution. And just a word of caution, a QCD sounds like an obvious solution for charitable giving, but there may be other factors that need to be considered. So for example, a client whose itemized deductions easily exceeds the standard deduction and who may be inclined to gift highly appreciated property could potentially receive a more favorable tax result by taking a different strategy. Also, you should consider your state's income tax rules. And as one final note, this can be a powerful tax planning strategy when it's used properly. But I would highly recommend that you seek advice of a local estate planning attorney or your financial advisor and potentially your accountant if you plan to utilize this tool for charitable giving. So I want to thank you for joining me in this episode. I hope that you find this content helpful. If you do find it helpful, please consider subscribing to the channel, and I'll look forward to seeing you in the next episode.